to tell you about Impax in general terms because it's our annual results tomorrow, so there'll be an RNS at 7 a.m. So I'm just strict instructions not to talk any numbers. So in that context, this is just an introductory description. Investment management is potentially a very, very attractive business if you can get it right. High growth as the demand for services grows around the world, very strong operating margins if you can keep control of your costs, which is largely remuneration of people. And if you can diversify that business across a number of different streams, you've got a very robust platform. Plenty of precedents out there in the listed market for investment management firms that have done very well over the years. Of course, the big gorilla is Schroders. Jupiter has shown how you can grow very rapidly from scratch in a couple of decades. There's also slightly smaller players like Polar Capital and Lion Trust, which are of the order of magnitude the same sort of size as Impax. Miton is in that group as well. You might know some of those names. I founded this business in 1998. Today I own about 7.5%. I've never sold any shares. So just going back to first principles, I have to try and drive this myself, but see how we get on. What is it about investment management in the environmental sector that stands out as worth backing? In the investment management space, it's very important to differentiate yourself because obviously there's a huge move globally towards passive investing. Everyone's got some money, but when they are investing it, they want to keep fees down unless there's a demonstrable reason to pay fees for good performance. So if you're going to be in active investment management, which is where you've got a team that's doing stock picking or private equity to try and beat the benchmark, beat the market, then you've got to have a pretty strong and compelling investment thesis. So what Impax has developed over the last 18 years or so is an investment thesis based around a segment of the economy which we call environmental markets, or for Americans, resource efficiency. They don't get the E word very quickly. And resource efficiency or environmental markets really is characterized by a set of industries that are growing more rapidly than the mainstream economy. On average, they tend to be delivering high rates of earnings growth, free cash flow generation, better return on capital employed. And so you can find assets in the environmental resource efficiency space that are cheap, but for some reason are out of favor, and you can assemble portfolios of those assets in a risk-controlled fashion. Then you have a good chance of pleasing your clients and justifying the fees that they pay you. So what we've been able to do in that 18 years of history is develop a suite of strategies based on some core investment insights which have stood the test of time and, generally speaking, have beaten benchmarks, which has meant we've been able to grow our client base. So in growing your client base and charging attractive fees, provided you can keep a well-remunerated, happy team, then there's no real reason to add significantly to that team as your assets grow. You've got scalable products. You can share the profits with the team, but fundamentally, when you stick it all together, you've got a great recipe for growing shareholder value. So when you look into our numbers, you'll have seen that over the years we have grown our earnings quite nicely. Balance sheet has grown very nicely, and today we're completely debt-free. We have a very strong cash position on our balance sheet, and I won't say anything more about the numbers, but the numbers have been pretty good. So maybe next slide. The left-hand bit is really a statement to say that for generalist investment managers, this is not necessarily a great time because of this drive to getting fees down. That's emanating from all sorts of reviews around the world, pressure from all sorts of stakeholders. Don't pay too much money for investment management because if you're not careful, that will erode value. That is a fair enough comment to the generalists. And so the generalists are really struggling. Some of them are merging, others are going out of business potentially. And meanwhile, those offering passive investment management services like Vanguard, for example, are seeing unprecedented levels of growth. Having said that, there are many specialist investment managers, and Polar Capital is a good example where they've got a suite of specialist teams doing different stuff, differentiated stuff that's successful. That's been a very good growth model for them. We're doing the same thing in the environmental sector. So the next bit, thank you. The formula for winners really is to be differentiated in investment management, to have a specialist approach, to have a diversified income stream, and then essentially to do what I've just been saying, which is to keep staff happy, deliver investment performance, and then with a nicely growing stream of cash flow to pay a rising dividend to shareholders, which we've been doing since 2008. So the next slide. Right, so what is it that we mean by environmental markets? Well, essentially, if you put together those industries that are addressing environmental problems, be that cleaning up air pollution or air quality improvements in emerging markets, improving water supply in emerging markets for new cities, or repairing water infrastructure in the US, European cities, Japanese cities, providing water for shale gas, shale oil exploitation in the US, improving vehicle energy efficiency, improving the efficiency with which food is moved or agricultural products are moved from the field through the processing part of the food value chain to distribution, and so on and so forth. Then I'm sure that you're all aware that the drivers behind these trends are secular in nature. More and more people on a finite planet consuming more and more stuff and requiring better and better standards of living. And intuitively that makes sense, and when you drill down sector by sector, you get some pretty compelling data that top line growth in these industries is typically better than it is in the mainstream economy, and EPS growth for companies that are specialised in these areas is also very strong, and typically 150 to 250 basis points better EPS growth per annum than, say, the all-country world index from MSCI companies. Next slide. A bit of data about the listed stocks that our listed equity team invest in. So on the left you can see the growth of the universe. This is companies with a majority of their business in environmental markets, growing from 250 companies in that universe in the late 90s when we started this business to over 1,000 or over 1,100 today. Those companies tend to be quite complicated. There's lots of complexity arising from regulatory change, technology change, M&A, and so that gives you a set of reasons why mispricing is quite prevalent, which is great for active investment managers. And there's a lack of sell-side research in simple terms, which means that there's an opportunity for us to really go underneath the bonnet of these companies and find out what's going on and potentially buy them before everyone else has worked out how much value there is there. Catalyst for investment, well, Hannah very helpfully pointed to one of the concerns about this sector, which is what will Mr. Trump do? And of course, Mr. Trump has started from potentially a blank sheet of paper, but has made some pretty robust statements about his positive vision for growth in the United States, for investment in infrastructure. He'll probably be quite supportive of the fossil fuel sector, and he may be somewhat negative about environmental regulation, for example, climate change policy. So in that context, Mr. Trump will be a bit of a curate's egg for us, because we do invest in the water sector, we do invest in recycling and cleanup for shale gas companies, and in the climate change related space, then we do look for investments in energy efficiency and renewable energy. So Mr. Trump is a bit of a curate's egg. In the rest of the world, however, there is almost a, not exactly a one-directional flow, but a very powerful group of drivers around demand. So the Chinese have just issued earlier this year their latest 5-year plan, which is dominated by spending and investment plans for the environment over the next 5 years. The European Union has very strong supranational and national policies around spending in energy efficiency, in improving water supply, air quality cleanup, and transportation, renewable energy as well. Plenty of reasons at the stock level why one should be quite excited about the potential for improved earnings and re-rating. So over the last 12 months, we have published the assets under management at the end of September, so we do that as a matter of course before the results come out. So the 4.5 billion under management is in the public domain, of course, 2.8 a year before, so we've had a 59% increase in assets under management, with most of that increase coming in our listed equity division. The other two services that we provide are infrastructure investing, where we fund the construction of wind farms, so we invest to fund equity component of construction of wind farms and solar projects around Europe, not in the UK, so France, Germany, Finland and Ireland. And then in the property space, we are we're running a small business which is investing in UK commercial property as 100% owners, and we invest to then invest further in the improvement of the environmental credentials, particularly around energy efficiency in the buildings before getting the buildings tenanted and sold. Next slide. This is my career for 18 years in one slide. It shows the growth of our assets under management every year, a snapshot at the end of every year from the start. So you can see a pretty solid track record of growth here, measured in terms of assets under management, with the 4.7 billion that we got to at the end of October. So we're 4.5 at the end of September, 4.7 at the end of October as a standout here. We've just announced before I came here, after the market closed, that we'd closed our third private equity fund, and we've raised 149 million euros for that. So that's just gone on the wires about an hour ago. So that will be in addition to that, those AUM numbers sitting there. It's very important in this space to be a partner to your clients. So we don't just provide fund management services, we provide for the 30 or so pension funds and around 45 other institutional investors an expertise service, if you like, advice about what climate change policy might do for their portfolios, information about the non-financial impacts that their assets are having, for example, on water supplies or materials consumption, and we're eyes and ears for them and regularly get phoned up to provide commentary about what the latest policy in, for example, Capitol Hill is on clean air emissions, or in Brussels around water treatment. So that thought leadership is a key part of the service we provide. This slide, which you'll have in front of you, is our shop window. It's a bit complicated to go through on the screen, but you should think of it on the left-hand side as our 6 strategies in listed equities. So we have a 15-person portfolio management team in listed equities, which is running 6 different portfolios. We have about 25 different funds which use one of those, each of which uses one of those portfolios. So that's the largest portion of our business. As it says in this box, we have about £10 billion worth of capacity, so we have the scope to take more than double the assets in that business. Plenty of headroom for growth in that context. The real assets on the right, in the light green, are the 2 funds that historically we've been running to own and build and sell wind and solar projects. The new announcement that I mentioned a moment ago is our 3rd fund, Impax Energy Investors 3, which has raised 149 million. That will continue to raise capital for another 15 months and should be the biggest fund to date in that space. And then the property fund you can see there is quite small. That's a business that we bought from a third party in 2014. The challenge for specialist investment managers is getting out there. How do you beat the carpet or pound the pavement successfully to win new business? And what we've done in the 18 years of life is quite entrepreneurially looked for ways that we can get out into different channels. So we started off with clients in Denmark and Washington. We then picked up we launched an investment trust in the UK market, Impax Environmental Markets PLC, which is now about £450 million of assets. That was launched in 2002. And since then we've grown a business which today is managing money. About 15% of our assets are from UK investors, about 50% are from North American investors, and most of the rest are from continental European investors. So you can see in the slide, and you'll have it in front of you if you can't quite read it, that BNP Paribas is one of our major distribution partners. They represent about 30% they've sold about 30% of our business, and they own 25% of our shares, which I'll come to in a moment. However, we also have distribution partners in North America. We've got 2 new Canadian distribution partners and a historical, well-established partner in the US, Pax World. And we've got other relationships in the Middle East and in the Netherlands. So it's a nicely diversified business model. We have sales teams in the UK and the US. Ownership is, I think of as a robust triangle. So if you're an investment manager like us, it's very important that the management team owns a decent share of the business, because otherwise incentives are could be potentially misaligned. So as I said, I own 7.5%. Management in total owns 38%, and BNP Paribas 25%. So management owns the lion's share, if you like, although we're not a concert party. BNP Paribas, as a major distributor, is very incentivized to keep growing the business for us, but because it represents only the minority of our business, then it's also enjoying the fruits of the sales activity in other channels. And the free float, which of course is the shares that are available to purchase in the market if management or BNP are not selling, is widely held. There are some UK small cap managers in there. Fidelity, for example, Phil is a declared shareholder. Remuneration policy is pretty straightforward. We aim to pay median level salaries, and we monitor what median means using third-party research. And then we aim to put 45% of pre-bonus profits into a bonus pot every year. So what that does essentially is it puts a lid on the total bonus pot, which means therefore that 55% of the profits pre-bonus go to the shareholders, from which corporation tax, of course, is deducted. That 45% is then split between the management team with the remuneration committee, the board, in the usual fashion. But I think the key point for shareholders and potential shareholders is that we've got a well-established formula for splitting the profits of the business between the investment team and other staff on the one hand and shareholders on the other. That's worked very well for over 10 years. The other point is that we are very keen to provide the younger employees or junior employees with more shares in the business, and we've been doing that steadily for the last 5 or 6 years, initially through an options program and latterly through what we call restricted share scheme, where shares are granted but vest over 5 years. And the crucial point is that the cost of those shares is expense in the usual fashion, but is a deduction from the bonus pot. So management gets a cash bonus, plus in some cases some shares, but the total cost of that is limited at the 45%. And moving towards a conclusion now, so this is our dividend history. We took the rather nerve-wracking step of paying a dividend in, I think it was February 2009, based on September 2008 results. Our main dividend was sort of in the teeth of the financial crisis, and at the time we announced a progressive annual dividend, which we've kept to religiously since then, and we initiated an interim dividend in 2014. Last year we paid a special dividend of 0.5p. So tomorrow that missing gap there will be filled in. And just to wrap up, I think what I've tried to communicate in the last 20 minutes or so is that this is a very exciting business. We have put in the hard yards for nearly 2 decades to build a global brand, which I think is recognised around the world as a go-to investment manager with specialism in these high growth markets. And at a time when the economy is struggling, generalist investors are worried about how they can meet liabilities, then I think the services that we provide stand out as a very attractive opportunity for institutional investors around the world to beat the market and to have a decent shot of paying their liabilities. And with a very stable team, with a good, robust compensation structure, a ruthless focus on looking after shareholders and a track record of doing that consistently, then I'd like to think that we are very well placed to have a strong, growing relationship with external shareholders in the future.